Today, we're tackling a topic that separates the amateurs from the professionals. Trend lines. Yep, those magical lines that look like we're just drawing on charts, but can actually unlock next-level trading insights. We'll show you how to use trend lines like a professional trader and spill the beans on some advanced strategies and techniques that could make your charts look like masterpieces. So, if you're ready to step up your trading game, smash that subscribe button, ring the notification bell, don't worry, it's free. Let's make this fun. All right, let's dive in. So first things first, what exactly is a trend line? A trend line is a simple yet powerful tool that connects the swing highs or swing lows in a trending market. Think of it as your trading GPS. It shows you the market's direction, helps you identify key price levels, and gives you a visual guide to potential areas of support and resistance. Trend lines aren't just for identifying direction. They can also help you anticipate breakout opportunities, manage risk more effectively, and refine your entries and exits. Whether you're trading Forex, stocks, or even crypto, mastering trend lines is like learning how to read the market's body language. It's a game changer. Let's talk about something you'll often encounter, a ranging market. As you can see in this picture, the market isn't trending up or down. Instead, it's moving sideways, bouncing between a clear resistance level at the top and a support level at the bottom. In a ranging market, swing highs and swing lows are less directional. They're confined within that range. While trend lines excel in trending markets, they lose their effectiveness here because there's no clear trend to follow. Drawing trend lines in a range can lead to confusion and false signals, making it harder to identify breakout points or reliable trade setups. So, why should we avoid ranging markets when focusing on trend lines? Simple. Trend lines thrive on momentum and direction. A range lacks both. Instead of trying to force trend lines where they don't belong, wait for a breakout, either above resistance or below support, before applying your trend line strategies. Remember, the goal isn't to trade every movement. It's to trade the right movements, where tools like trend lines give you an edge. Let's move on to a downtrend. Trend lines connects lower highs and lower lows, signaling consistent downward momentum. Here, we have a clear example of how the market moves when it's trending down. You will notice a pattern, an impulsive move where the price aggressively drops, followed by a corrective move where the price temporarily pulls back. This cycle repeats, impulsive, corrective, and so on. Now let's break it down further. At the bottom of each impulsive move, just before the corrective move begins, we identify a swing low. On the flip side, at the top of each corrective move, just before the next impulsive move starts, we spot a swing high. In a clear downtrend, the price will consistently form lower lows. Each swing low is lower than the previous one. Similarly, the swing highs during the corrective moves will also be lower than the highs before them. This pattern of lower highs and lower lows is a hallmark of a strong downtrend and makes it ideal for applying trend lines to guide your trades. By connecting the swing highs, we can draw a trend line that acts as resistance, helping us spot potential areas where the price might reverse or continue its downward momentum. Now, let's switch gears and talk about an uptrend. In an uptrend, the market is moving higher, with a clear pattern of price increases and pullbacks. Just like in a downtrend, we see two types of moves. Impulsive moves, where the price pushes upward strongly, and corrective moves, where the price pulls back slightly before resuming the trend. At the top of each impulsive move, just before the corrective move begins, we identify a swing high. At the bottom of each corrective move, just before the next impulsive move starts, we have a swing low. So why do we even draw trend lines? What's the point? The first reason is that trend lines can act as dynamic support or resistance levels. Let's break it down. Resistance. At the top, the trend line often acts as resistance. When the price reaches this level, it tends to struggle to break through, and we often see a reversal or a pullback. Support. Along the bottom, the trend line acts as support. Notice how the price bounces off the trend line multiple times, signaling a strong area where buyers step in to push the price back up. By identifying these levels, we can make better trading decisions, like timing entries, exits, and stop-loss placements. Essentially, trend lines help us anticipate where the market might react, giving us a critical edge in our analysis. The second reason we draw trend lines is that breaking a trend line can signal a possible trend change, and this is where things get interesting. Take a look here. We have a clear uptrend with our trusty trend line drawn along the bottom of the price movement. Everything seems great, higher highs, higher lows. It's like a parade of bullish confidence. But then, bam, the price breaks below the trend line. That's the market's way of saying, party's over, bulls. It's bear time now. When the trend line is broken, it's often a sign that the uptrend is losing steam and the market might be shifting to a downtrend. Think of it like your GPS recalculating when you take the wrong turn. It's a warning to reassess your direction. For traders, this can be a signal to tighten up stops, close positions, or even start looking for opportunities in the opposite direction. All right, let's dive into how to draw trend lines properly. It's not just about connecting dots. There are a few key concepts to keep in mind. Obvious trend lines are better. Look for trend lines that are clear and easy to draw. If it jumps out at you, it's likely jumping out at everyone else too. And remember, the more people watching a trend line, the stronger its influence on the market. More touches, the better. The more times the price touches a trend line, the more significant it becomes. But let's be real. Just because a trend line held 5 times doesn't mean it will hold the 6th. Trend lines aren't invincible shields. They're more like helpful guides. Trend lines are areas, not solid lines. Just like support and resistance levels treat trend lines as zones rather than precise lines. The price might respect the trend line perfectly sometimes, but other times it will hover slightly above or below it. Flexibility is key here. Don't force a trend line. If it doesn't fit, let it go. A forced trend line is like forcing puzzle pieces together. It's not helpful and usually ends in frustration. Use trend lines as part of your overall analysis, not as the ultimate decision maker. By following these principles, your trend lines will not only be more accurate, but also more reliable in guiding your trading decisions. In the next topic, we're going to focus on the 2 main types of price action setups, trend continuation and trend reversal. These are the setups we use to enter trades, so let's break them down. Let's start with trend continuation setups. These are patterns where the market takes a brief pause before continuing in the same direction. Think of it like a pit stop in a Formula One race. The trend slows down for a moment, refuels, and then powers ahead at full speed. For example, imagine price makes a strong push to the upside. That's your impulse move. Then it starts moving sideways, consolidating. Here's where we draw a rectangle around this consolidation. Notice how the price fits perfectly inside the rectangle. This is a rectangle pattern, a classic continuation setup. The price pushes up with an impulsive move, then it consolidates, correction. And finally, it breaks above the rectangle and continues its upward journey. This pattern reflects the natural behavior of the market. Impulse, correction, impulse. So when you see this setup, you're looking to enter a buy once the price breaks above the rectangle. Sometimes price might pull back slightly for a retest after breaking out, and then resume its upward trend. Be mindful of this retest. It's like the market catching its breath before the next move. Next up, trend reversal patterns. Imagine the price pushes up and consolidates sideways into a rectangle, just like before. But this time, instead of breaking out to the upside, it breaks below the rectangle and starts heading down. This is a reversal pattern, and it tells you the trend is likely changing direction. Here's what you do. Draw your rectangle around the consolidation, and if the price breaks below it, you're looking to sell. Simple, right? Remember, the breakout direction tells you whether it's a continuation or a reversal. Now, let's talk about wedges. These patterns are slightly different from rectangles. First, we have the falling wedge continuation. Picture the price pushing up, then correcting downward, but in a converging pattern where the highs and lows get closer together. That's a falling wedge. Once price breaks above this wedge, it's likely to continue pushing upward. That's your cue to buy. On the flip side, we have the rising wedge reversal. Here, imagine price pushing up but forming higher highs and higher lows in a converging pattern. That's a rising wedge, and it signals a possible reversal to the downside. When the price breaks below this wedge, you're looking to sell. Wedges are powerful, But remember, wait for the breakout before you take action. Don't jump the gun. Finally, let's talk about flags. Flags are one of the most commonly seen patterns in the market. First, we have the bullish flag, a continuation pattern. After an impulse move to the upside, the price starts correcting downward in a tight, sloping pattern. That's your bull flag. To trade this pattern, wait for the price to break above the flag, then enter your buy as the market continues upward. Pro tip: flags are similar to rectangles, but they tend to slope slightly, making them easy to spot once you know what to look for. Now, for the bearish flag, this is a reversal pattern. If the price starts correcting upward after an impulsive down move and then breaks below, that's your cue to sell. These patterns are reliable because they reflect the natural ebb and flow of the market. If you focus on just these three patterns, rectangles, wedges, and flags, you'll improve your trading significantly. Trust me, you'll start spotting these everywhere on your chart. Now, picture this example. We have a perfect downtrend, and we draw our trend lines to confirm the trend direction. At the top here, we have a strong resistance level that's preventing the price from pushing upward. This resistance level adds to our confluence, giving us a solid reason to place sell orders at this level. But here's the key. We don't just blindly enter a trade just because price is at the resistance level. We wait for confirmation. In this case, we have a continuation pattern forming. We wait for the price to break below the pattern, and then that's our cue to enter the market with sells. As we continue to move downward, we spot another continuation pattern, confirming that the downward movement is likely to continue. Again, we wait for the pattern break, and when it happens, we enter with another sell. Finally, as the price breaks out of the downward trend and makes a minor retest, we can see that the trend has changed. This is our signal that the bearish trend has come to an end, and now we're looking for buying opportunities. And that's how we combine trend lines, price action, and key patterns to guide our trades. Whether it's continuing with the trend or catching a reversal, understanding these setups can give you the edge you need. Thanks for watching. If you found this helpful, don't forget to hit that subscribe button and ring the bell so you never miss our latest insights. Leave a comment, share your thoughts, and let's keep learning together. Until next time, happy trading